This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. This is Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And of course, every time you hear that song, I can see clearly now, you know you better pay attention. Because we have a guy or a woman, wherever they are, they can see. And our job is to help you see clearly now as to what's coming down the road. And today, our very special guest, one of the most popular guys we have, is Bert Doman, fellow Hawaiian who now lives in L.A. But he's going to be talking about a subject all of us have to pay attention to. And it's what is going on in the stock market and the credit market. And the problem with most people is they watch the stock market. They don't know what the credit market is or the bond market or the debt market, whatever you want to call it. So it's a very, very important show because the crash is going to be spurred by the credit market, which will bring down the stock market. So I can see clearly now, this is possibly, we've had several guests on with the same subject. We had Brian Reynolds talking about what he called the daisy chain of investing. And I hope you listened to him because what he had to say was shocking. And today's guest, Bert Doman, is the expert on this stuff too, because that's all he does. He and I are neighbors in Hawaii. When I was growing up, Bert was the guy. Whatever he said, people listened. Now they didn't like what he said a lot of the times because he popped their little bubbles, but he calls it as he sees it. He doesn't sell stocks, bonds, mutual funds, and ETF. He just sells information, his own information. And his letter that we subscribe to is called the Wellington Letter. So if you want to see the future, stop watching the Kardashians and start studying the Wellington Letter and Bert's words. And once again, Kim is not here. She was just in Peru, and she's now in Mexico, having a great time there, talking to all the women there about how to be a richer woman and dump the poor guys. Anyway, whatever she talks about. So, Bert, welcome to the program.
Thank you very much, Robert. It's always great to be with you and your listeners.
Yeah, thank you. Hey, could you just step back because all the guys on the show are like me. We're not, I'm primarily a real estate guy and I'm an entrepreneur. And I've never understood the bond market. Every time I went to the bond market to take classes, I just don't understand it. So, when I was in about 1970 or 80s, interest rates were about 15 to 19%. Now they're going to zero. Now that's good news for the guys who understand bonds, because as the yield on bonds went down from, let's say, 15% to 1% today, it's great news for the investor, but it's bad news for mom and pop savers. So I just never understood the bond market, probably because I never had any money to put in it anyway. But as you say, and a lot of people say, the average person only knows about the stock market, but they're clueless to the bond market. Would you mind give us your insights on that?
Well, the bond market is so much bigger than the stock market, Robert, and very few people look at the bond market because it's not exciting enough. People love excitement when they invest. I think that's kind of foolish. I think what you should look at is profits that you want to make on your investment, not the excitement. If you want excitement, go into some of the scams like cryptocurrencies, etc. You get lots of excitement in that, but of course, you're going to lose your shirt.
But Bert, there's scams everywhere, no matter what you do. So you just got to be aware anyway, right?
Exactly.
Yeah.
And this is the most important thing. When you get somebody's advice, always see what does he do? Where does he make his money? If you see somebody who works for a Wall Street firm that makes money on commissions, you know that he can never be bearish on the stock market. So you will never get his real view on the stock market. It's the same thing with money managers. Somebody manages money. He cannot be negative on the stock market. Even if he sees a crash coming and all the signs are out there, he cannot say it because then his clients would say, well, why are we 80% invested in stocks if you're bearish on the stock market? So you always have to see where is the person making money? That's why we have no conflicts of interest. We do the best research that I think you can get. We've been in business for 42 years, and we have no conflicts of interest. I've avoided them all the time. And, for example, there was a time when gold was soaring. Everybody in our business was going into the gold selling business, gold coins, etc. And it was very tempting because we would get phone calls all the time from our subscribers. Can I buy gold coins through you? And I said, no. We decided we don't want to get into that business because eventually there will be an end to the bull market. And that was in 1980. And then what am I going to do if I have 10 or 20 people sitting on the phone selling gold? And so, then the conflict of interest becomes very serious. So then are you going to tell people to sell gold? Or what are you going to do with these people on the phone? So anyway.
So Bert, can we get back to the
advice.
Bert, so let's say I buy a U.S. bond or a note, whatever they call them, and it's paying 10% interest, and then all of a sudden interest rates are at 1%. Why is that good news for the guy with a 10% bond?
Well, because the way it works, when the interest rates decline or the yields on bonds decline, then the price goes up to adjust. Because the new bonds that are coming out, if you have a bond that yields 10% when you bought it, and suddenly the yields on new bonds coming out is 5%, only half that, then suddenly you have something of great value.
Right.
Then the bond, if you want to sell it, it's giving you a yield of 10% is worth about twice as much.
So
it's not quite mathematical, but that's the way it works.
So where we're
So you
talking
can
about
get much more money.
Yeah, where we're talking about this before we got on the air. So, it's been, like you and I are old enough to remember 15, 20% interest rates and all those hyperinflation.
Yeah.
But today, Bert, we're going to negative interest rates. Have you ever seen that?
Yeah. No, this is the greatest mistake of the central banks in history of mankind. We have never had negative interest rates in 5,000 years, or as long as written history has been recorded. It just doesn't make sense. Why would you, if you borrow money, why would you, which is when you issue a bond, you're borrowing money, why would you then ask the buyer of the bonds, the person who lends you money, to give you interest on top of that? Yeah, it just doesn't make sense. And this eventually is going to cause a global calamity when interest rates rise. If they ever do rise, we don't know how long it's going to take, maybe 10 years, maybe 20 years. But when interest rates rise, all of these bonds that are outstanding at very low or negative yields, they're going to go down in price. I would say 60% declines in bond prices.
Let me use a real simple example. Let's say I have $100,000 and I buy a bond with let's say negative 2%, and it's 10 years. So that means in 10 years I get 100,000 minus 2%. Is that correct?
Yes.
I lose money.
You lose money.
And if that same time all of a sudden it goes from negative 2% to, let's say, 5% positive, what happens to my negative 2% bond?
Well, you're not going to have anybody wanting to buy that bond, so you have to lower your price to attract the buyer, and you might have to lower it by 60, 70, 80%. It will cause, we just had, last month, we had $17 trillion of negative yielding bonds in the world. 17 trillion, not billion, trillion.
So Bert, hold on. So let's say interest rates go up to 5%. What happens to that 17 trillion?
Well, the value of that would be down the similar amount. I would say probably 70%, 80%. So that money would go up in smoke. The holders of these bonds would incur a loss of probably $14, $15 trillion.
Jesus.
That is immense. I mean, that would really break the bank.
So Bert, so hang on, everybody. Please listen to this, okay? The reason we have Bert on this program, we play that music, I Can See Clearly Now. So Bert, being you and I are the old guys now, what do you say to people about this situation we're in today?
Well, it's crazy when something doesn't make sense. It eventually will cause a crisis, and we saw that in 2007. We saw similar things, and I wrote a book at that time predicting a crash in 2008, and nobody wanted to believe it. My book was called Prelude to Meltdown, and we saw the meltdown 1 year later. My book was published in January of 2008. So there were things that didn't make sense, like the CDOs, etc., all the junk mortgages, etc., being sold all over the world.
The real estate derivative mortgage market.
Yeah.
So let me ask you, why?
Now again, we have the same thing again, but not in the real estate market.
So let me ask you.
In the bank.
Yeah. So it's going to be credit market. It's going to blow up.
Yeah.
So if the bond market is bigger than the stock market and the real estate market, what happens if $17 trillion at minus 1%? What happens? Is it going to be bigger or less than the 2008 meltdown?
Well, I always try to look ahead. And if interest rates should start rising, then the central banks, the alarm bells start ringing when the banks say, hey, our bond portfolio is down 60, 70%. You have to rescue us. Then the central banks will fight that by printing as much money as they can in order to get interest rates down again. Okay? And they will be able to do that for a certain number of times until suddenly nobody wants all that confetti anymore that they're printing, which some people call money. And then, of course, you start inflation. And then you get a situation like Venezuela, Zimbabwe, etc., where nobody will want the currency. Then the laws will be made that you have to take the currencies in exchange for trade. But by that time, I think they want to have a digital currency like Bitcoin, but issued by the government. And therefore, the government cannot allow something like Bitcoin or Libra from Facebook to exist. Okay? So then the sole issuer of digital currencies will be the government.
Once again, it's Robert Kiyosaki, the Rich Dad Radio Show. We're talking to Bert Doman. The theme of this show, again, is I Can See Clearly Now. And Bert, I tell you, I've known him for years. This young guy walking around Waikiki. And boy, when he talks, people listen. They don't like what he says all the time, but they do listen. So we come back, I think, listening to what Bert Doman has to say right now. Again, his website is Doman Capital, DOHMEN Capital.com. He's the author of Prelude to Meltdown, and he's talking about what's happening today, not back in 2012. What's happening today, and ladies and gentlemen, please pay attention. Please prepare. We'll be right back. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. Once again, listen to the Rich Dad Radio program anytime, anywhere on iTunes or Androids. And all of our programs are archived at the Rich Dad Radio Show. We archive them for one reason. We don't sell anything. We are a purely educational company. We archive them so you can listen to this program again, especially this program, because when you listen to it again, you'll learn even more. You'll pick up even more nuances you didn't pick up the first time we passed over this. And you can listen to this with your friends, family, and business associate and discuss it. When you do that, you'll see a whole nother world. You can see clearer now. Our guest today is Bert Doman, his old friend from Hawaii, now living in L.A. His website is domancapital.com, DOHMEN Capital.com. He is a publisher of the Wellington Letter, and it's one of the letters everybody in our company reads because we need to see the future all the time. So before we go any further, Bert, would you tell us a little bit more about the Wellington Letter and how much it costs to subscribe?
Sure. Robert, let me just correct one statement. I don't live in L.A. I live at Lake Tahoe.
Oh.
And so L.A. is, we have an office in L.A., and so that's why I'm down here once in a while. But anyway, the Wellington letter is $69 a month. We usually have 2 or 3 issues a month, and they get they seem to be getting longer as the markets get more volatile.
I noticed.
So usually it's around 20 pages or so. It's the best value there is.
How much is it again? How much is it again?
$69 a month.
A bargain. What a bargain of what you get.
Yeah, it is a bargain. I mean, especially we have called every significant market decline and bear market in the last 42 years since we've been in business. I don't know anybody else who can claim that, but our track record is in writing and all the past issues, so can all be verified. And, for example, the issue that was put out last, it was, that would have been at the beginning of October. We said the cracks in the ice are widening and they're starting to break. And I said they're going to be breaking in October. And so we've seen what's happened since that time. Too many people think that, the market is in bad shape or there are problems sometimes because of the Chinese negotiations and so on. But under the surface, there's much more going on. Do you know that, for example, everybody watches the S&P 500 or the Dow Jones Industrials? These 2 indices are fake. They are, just like your book, fake. I mean, I love the title of that book because I wrote that a few months ago. I said everything is fake nowadays. There's nothing real anymore.
Yeah.
So anyway, I forgot. Lost the train of thought.
And we're talking about the S&P and the Dow as fake.
Yeah, the indices. Yeah, it's about a dozen stocks that control the S&P 500. 500 stocks, and 12 of them have the highest capitalization, and they're the ones that are moved around by the high-frequency trading, all the algo traders. These are the computers, no human intervention and so on. And when they want the market to go up, they just manipulate those 12 stocks to go up.
And are the FANGs?
Usually Apple.
Are the FANGs some of those stocks?
Yes, and the FANG, they are amongst them, but the FANGs have now, we've seen the big selling. They're the last ones to be sold. Apple is the last stock they hold up because they want people to stay bullish as long as possible before they pull the plug on Wall Street. Okay? So everybody watches Apple. If Apple is going up, they say, the stock market is doing great. Baloney. The value line index is what we use. The value line index is 1,660 stocks. Okay? Many more than the S&P 500, many more than the $30 stocks. Okay? And these that index is not capitalization weighted. Capitalization weighted means that a company has many more shares outstanding, like Apple, and then another company is valued more. A dollar rise is worth much more for a stock like Apple than a dollar rise in a smaller company. So the value line is each stock has its own value. It's just like every other stock. This is the most reliable measure of what the stock market is doing.
What is that? What is that index again? The value line?
Value line. Okay. And there's a value line A and a value line G. We use the G, which stands for geometric. It's a geometric average.
Okay.
But don't worry about that.
Yeah, so they just subscribe to the Wellington letter. That's all I say, okay? Because you guys, otherwise you'll go blind. We
show the chart all the time. Here recently it was down 16% from the September 2018 high, down 16%, while the S&P was at a new record high. What does that tell you? It tells you that the S&P and the Dow Jones and everything that you hear on financial TV is false. They always say, the stock market is up today, new record high. That's baloney. Here you see what the real market is doing, the value line. Or you can use the New York Composite, which has every stock on the New York Stock Exchange, is also much better measure of the stock market. But what we've seen here since the end of January of 2018, we have seen a totally phony rally. There's been only one big class of buyers since that time, buyers of stock, and that's stock buybacks of companies.
Right.
Companies buying back their own stock.
And
Nobody else, institutions, pension plans, individual investors, nobody has been a buyer of stocks.
So let's get into this, because we started this program is that most people watch the stock market, but not too many people watch the credit market. And we had Brian Reynolds on a few sessions ago, talking about is the credit market and how state governments are raising taxes, and they go out and they buy this corporate debt. And this corporate debt, like with AT&T, Ford, General Motors, and all that, they've come down from AAA to BBB, one level above junk. And so these corporate CEOs are then buying back their own stock with the company's debt. But what are the CEOs doing, Bert?
Yeah, that's a very good question. The CEOs this year have been big sellers. It's a record amount of insider sales. This is what it's called, insider sales. These are the top executives. They have been net sellers at a record pace this year. And at the same time, they have then been buying their company stocks for the company. These are the stock buybacks. So they do these buybacks, many of them with borrowed money, and
debt.
With debt, and that supports the price of the stock while they are selling the stock in their own personal portfolios. This should be prosecuted. This should be so illegal. What they are doing, this is sheer manipulation of stocks, but the regulators are asleep. And this should not be allowed. But if you know that this is happening, then you know that this alleged market strength is totally phony. In last December 2018, the stock market went down a big amount. It was really like a crash. And the first time we've seen that in decades in December. December is usually a positive month for the stock market. But we saw this crash. And what happened then, the CLO market, these are loans that banks sell in participations, very much like the mortgage participations, the CDOs, the last crash. Now they're doing it with leveraged loans. The banks have these bad loans on the books, and they sell them in the pools to institutions that are looking for higher interest rates. They know this stuff is garbage. And then in November of last year, that market froze. There was no liquidity. Banks were trying to sell $400 million worth of that stuff. There were no buyers. Then the junk bond market dried up. There were companies that were just still trying to issue junk bonds. No buyers for the junk bonds. When you see these credit markets freezing up, you know there's trouble ahead. Okay?
Big trouble.
And what did we see recently here? It was the repo market.
That froze.
Nobody really understands. The guys on TV don't understand it. But it's a Federal Reserve, and basically suddenly it froze. This is a huge market. It's about $50 billion a day that banks borrow overnight. Usually it's overnight, very short. They give a security to Treasury bonds that they have. And then the next day they repay it. Okay?
Right.
It froze up. And the Federal Reserve had to jump in. This was a huge warning. The Fed funds market freezing out. The last time it happened was during the last financial crash.
Correct. So Bert,
2008.
So Bert, look, we have these CEOs are borrowing money using company funds to borrow. It jacks up the stock price. They exit. It leaves zombie companies like AT&T is BBB right now. Ford is BBB. GE is BBB. That's one level above junk. Now, there's two kinds of people that will be hurt directly from this. Is that if you're an employee of, let's say, General Motors or AT&T or Dell, and then the investors, because they're going to exit out. What advice would you give for, an employee of, let's say, GE, or an investor in, a 401k or an ETF holding AT&T or General Motors stock, what do you say to them?
Well, we don't give personalized advice to individuals and their situation, but in general, I would not want to have any of this confetti. That's just one level of junk, because during the coming recession, that is all going to go into the junk category. What does that mean? That means that ETFs and mutual funds and institutional money managers will have to sell those bonds, because they are not allowed to have junk bonds in their portfolios. They have to sell those. And that comes just at the wrong time. Everybody has to sell, and where the buyer's going to come from during that time? This is where you have a credit market fiasco.
Everybody, please listen, because we're talking about the credit market versus the stock market. And what Bert's talking about is you have a triple B bond, you're still investment grade. You drop below triple B, you're now junk, and nobody's going to be able to buy it. Is that basically what you're saying?
That's exactly right.
And then the crash, the
As
whole
always,
crash comes
Robert,
in.
you understand it very well.
Well, thank you. It doesn't make sense to me. That's the problem, Bert. Why would anybody do this to their own company?
Yeah. Well, because they put their personal interests ahead of the interests of the shareholders.
Right. So, like I've been a gold bug since '72, and I have lots of it. And every time the price dropped, I just bought more of it, because I'd rather save gold and silver than cash. And what are your thoughts on gold at this time? Or silver, or any kind of what I call tangible hard asset?
Yeah, in 1980, which was the peak, gold went over $800, and we gave a sell signal that nobody wanted to believe.
Yeah,
and
Bert, you disturbed me immensely, because that was my retirement. I was in Honolulu going, what's this guy saying?
And, we said, this is going to be a 20-year bear market.
You did.
And people said, you're crazy. 20 years? What would cause a 20-year bear market?
And it was exactly to the day almost, because in the year 2000, gold hit $250, down from $800.
Exactly. 2001 was the bottom. 2001, it started lifting off again. It was exactly 20 years. Our study was a cycle study. And usually cycles, as you know, they're not that accurate. It may be a 20-year cycle, but it may turn out to be 18 or 19 years or 21 years. But this one was right on the button. And also in that cycle study that we made in 1980, we said, and that is going to be followed by a 30-year bull market. And what would cause a 30-year bull market, we have no idea. But here we are.
So you called that way back then?
Yes.
So from 2000 to 2030, it's going to be a bull market?
We basically went to studied the cycles of gold, 200 some years in the U.S., and on top of that, then we had to go to England, where gold was trading before that time. And so I think it was about 400 or 500 years of history. And so it was just absolutely amazing. But within that, you have some pretty stiff bear markets,
right?
So there's something called a cyclical bear market that can happen in a secular bull market. And in my opinion, we're still in a secular bull market that will go to new highs eventually. But you have to watch out. The kind of situation we're going into now, if it's similar to 2008, there's going to be a rush to liquidity. The problem in the markets today is lack of liquidity. And write this down, anybody who's listening. Liquidity is a big problem in all the markets right now. And Stanley Druckenmiller, who's a very successful hedge fund manager, he managed George Soros hedge funds and so on. He had a fantastic track record. He said liquidity is the most important thing you want to watch in the markets. And so we watch it very, very closely, and liquidity is drying up. And this is the repo problem. I talked about it before.
Right.
It showed
that's the credit market.
Lack of liquidity in the credit markets.
Right.
And that is the thing you want to watch.
Please listen to this.
So what's going to happen now? Gold will probably have a stiff correction.
Correct.
And I don't know how deep it will go. And just like we had in 2008, gold went down 31%, and the gold miners, the ETF, the GDX as the symbol, was down over 70% in 2008 because everybody was selling just to get cash. Nobody had cash.
Right. That's liquidity. That's liquidity.
Yeah, that's right. You sell what not what you want to sell. You sell what you can sell.
And what you call that, and what, Bert, you taught me this. You call that a short squeeze, right?
Well, no, that's not a short squeeze.
Not?
No.
Oh.
The short squeeze when everybody's short, and then they push the market up. It's
I thought it was when you have to dump your most liquid asset, which in
no.
Okay.
No, that's not right.
Okay.
So this would be just a rush to cash, and then when the situation in the credit markets got less bad in December of 2008, then and everybody was out of gold. Nobody wanted to even hear the word anymore. That was the time to buy it, and then you had the big rise. And that's going to happen again, in my opinion. So you're going to have a stiff correction, and then eventually you're going to have everybody rushing to gold because it becomes evident that the central banks, including the Federal Reserve, they have to step on that accelerator as hard as they can, print all the money, throw it out there, throw it out of helicopters, as Fed head Ben Bernanke said at one time, in order to keep the system from collapsing.
Right. Hey, Bert, once again, thank you very much for all your insights, and I hope everybody can see clearer now, because that's why you should subscribe to Bert's Wellington letter. You can get it at domencapital.com, DOHMEN capital.com. And Bert, once again, thank you for all your wisdom, and so people can see better.
Well, thank you very much for the opportunity. It's always great speaking with you, and I wish your listeners really lots of success.
Thank
Do
you.
not disregard the things that I said here today.
Thank you.
And what I told our subscribers is this is a good time to put your financial TV on mute. That's why they have a mute button on your remote control.
That's the best advice I've heard all day. So, Bert, thank you again.
All right. Thank you. Take care.
Thank you. And when we come back, we'll be going to Ask Robert, the most popular part of our program. We'll be right back. Once again, thank you to Bert Domen. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. Once again, Kim was in Peru. She's now in Mexico, and she should be back soon. And once again, also I thank Bert Domen of Domen Capital, DOHMANCAPITL. His newsletter is a Wellington letter. Please get that if you want to see the future, because that's all it's a great, most informational, educational newsletter on the market, because he writes in everyday language. I love the Wellington letter. And you can listen to the Rich Dad Radio Show anytime, anywhere on iTunes or Android. And if you want to listen to this podcast again, go to richdadradio.com. We archive our podcasts so you have a chance to listen to this again, and most importantly, discuss it with friends, family, and business associates. The more you discuss, the more you listen, the more you will see. You will see clearer now. So going into Ask Robert right now, you can submit your questions to AskRobert@richdadradio.com. First question, Melissa.
Our first question, Robert, comes from Trini in Irvine, California. Favorite book, Rich Dad, Poor Dad. In Fake, you mentioned that stock is fake assets. If stock is fake, how would you explain the success of Warren Buffett?
Warren Buffett's at the right place at the right time. Markets change constantly. You heard Bert talk about cycles. So from 1970 till today, probably 40, 50 years, how long it is, stocks was the place to be in. Was the place, not today. So you got to understand that what really captures or what traps people is they get complacent and they think, well, tomorrow will be like yesterday. And when you have that mindset, you're screwed, because we're going. Everybody I talk to, like Bert, we've never been here before. How can you have negative interest rates? How can you have $17 trillion paying nothing, or charging you money to be rich? And we have socialism with AOC and Elizabeth Warren and Bernie Sanders coming up. So just don't get complacent. Also remember this. they cover it up quite a bit, but Warren Buffett's fund lost 40% for 10 years. He went down between, I think, 2000 to 2010. He got his butt handed to him. So, ladies and gentlemen, don't just sit there, and I think Bert was saying that, just don't drink the Kool-Aid being pumped out there by Bubble Vision, CNBC, and all these magazines. Always be careful who you listen to. As Bert said earlier in this program, if somebody's selling stocks, they can't tell you that stocks are bad. And if somebody is selling dogs, they're going to tell you my dog is healthy. So the purpose of the Rich Dad Radio Show and Bert's Dolman letters is to have you wake up. We've never been here before. How in the world can we have $17 trillion paying negative interest rates? Think about that. And how can we have so many zombie companies, such as General Electric, Triple B, it used to be Triple A, AT&T, the biggest debtor nation in the world today, company in the world today, Triple A to Triple B. General Motors, Triple A to Triple B. Ford Motor Company, Triple A to Triple B. So you want to keep buying those stupid stocks? Hang on to them. Invest for the long term. Diversify. And when the shift comes, you go, what went wrong? Well, the market changed on you, and that's really what's going wrong. We're in a different cycle of human evolution in markets. That's why I started the Rich Dad Company. That's why I write my books. That's why I created the Cashflow game. My frustration is most people don't change. They think tomorrow's going to be like yesterday, and those are the guys that eat lunch. Next question, please, Melissa.
Our next question comes from Vasil in Romania. Favorite book, Rich Dad, Poor Dad. It says, Robert, you mentioned in your podcast with Mike Lindell that everyone is addicted to something, and I agree. I'm addicted to procrastinating. My question is what's your advice to a 20-year-old who's struggling to find motivation to go out there and start hustling?
Do nothing. Just procrastinate until you get tired of it. I procrastinate a lot of the time, I'll just tell you that my thing was this, is I really hated school, but I love learning. So I started just attending seminars. Like I tell so many people, I was talking to this friend of mine here, I've known her for 20 years now, and she's still flat broke. I said, how many seminars have you gone to? She goes, none. So I don't have any money. Why do I talk to her? I don't understand that. I said, there's a lot of free seminars. Go to the free seminar. Spend some time listening. Well, I don't have time. That's why, I just don't know why I even bother doing the show a lot of the time. I don't know why. And like I said, the first question coming in, if you expect tomorrow to be like yesterday, I think you're going to get your butt handed to you. So the thing that I did is, since I hated school, I would attend these seminars for free. Like I learned about this, learned about that, and I sit and I take a seminar because I like spending only 2 or 3 days learning something. But every time I learned something new, I got kind of inspired and I chugged along. So I've done seminars on stock trading, bond trading, which I don't understand yet. I do all these goofy things. I always met different people at them because they were proactive, not lazy SOBs. I just can't stand it anymore. Tomorrow's not going to be like yesterday, sports fans. So you want to be lazy? Enjoy yourself. I've done it myself. But nothing's going to motivate you like poverty. I tell you what, that's what's going to motivate a lot of people. But thank God, young people like you all believe that the government owes you a living, and that's called MMT, Modern Money Theory, or the Magical Money Tree, or Helicopter Money by Ben Bernanke. And that day is coming too, and I'm excited about it because that's when I'm going to get even richer, because when they start dropping helicopter money, I get richer. And as Bert was saying, the price of gold will go down. I get excited because I'm going to buy more gold. The whole thing is I don't really care. I just see things changing day by day. I want to see clearly what's going to come in the future. But most people are effing lazy. They just sit there and expect tomorrow to be like yesterday. So thank you for listening to the Rich Dad Radio Show. You can send your questions to Ask Robert at richdadradio.com.
bao